Now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And welcome to the show this morning. Of course, it is Thursday, the second best day of the week. It's also our last live show of the year. So don't panic, as I've been telling you about for the last few days. If you haven't been to the website, realinvestmentadvice.com, just drive over there real quick. Just a quick trip around the corner on the keyboard. Click on Resources tab and go to our podcast. And we will have podcasts for you every day through the end of the year. It's our best stuff from the year. It's all enlightening, good content, wholesome family entertainment for your Christmas listening enjoyment. You can bore your kids and family with your daily podcast of The Real Investment Show. It's all there for you at realinvestmentadvice.com. But yeah, we're going to take a few days off for the end of the year, come back all fresh and renewed. Don't forget also that our early bird special for our upcoming conference in January will end December 31st. It's $99 right now to get tickets. The tickets will go up to $149 at the beginning of the year. Seating is limited because it's in a hotel here in Houston. So there are limited seats. So if you want to come to the conference, we myself, Michael Lebowitz, we'll have Danny and Richard there as well on a panel. Adam Taggart will be there, may have a surprise guest on top of all of that. So we've got a lot of stuff in store for that conference. But if you want to come, be sure and get your tickets on now early while they're less expensive. So there you go, realinvestmentadvice.com. Banner's right at the top. Registration's easy. Okay. Couple of things. Yesterday, under a lot of pressure from Donald Trump, the continuing resolution to keep the government from shutting down, Speaker Mike Johnson, who is a complete disappointment because he has absolutely, I've never seen a live jellyfish before until I saw Mike Johnson. He has no backbone whatsoever. And anyway, they were trying to push through this continuing resolution that was just full of all kinds of pork and spending and all kinds of other stuff that have absolutely nothing to do with keeping the government operational. But this is the way they do things. It was a 1,500-page bill. Shove it onto the desk. Get everybody to sign it. Everybody sticks in their wanted to, their kind of their Christmas wish list. And that was what was in it. Well, Donald Trump actually pressed back on that. That spending bill has now fallen apart. So part of the pressure yesterday was not just the Fed, it was also this issue because now there's a risk that the government could shut down here fairly shortly. That's not the end of the world. We've had government shutdowns before. They get together, they pass a spending bill, we keep spending more money, and they open the government back up. But again, if the government does shut down, you furlough government workers, and this is part of the problem that Trump may face in trying to reduce government, is you really can't. It's really pretty difficult. We don't fire government workers, we furlough them, which means they actually keep accruing their wages until they come back to work after the budget bill is passed, so they get all their money back. So it doesn't really adjust spending, but these continuing resolutions are simply just taking last year's spending, adding 8% to it. Everybody makes more money. Congress, by the way, was trying to sneak in a pay raise for themselves for the end of the year as well. I believe it was from $177,000 to $254,000 a year for doing crap. They do. So that's part of the issue from yesterday. Of course, the other big issue that we'll get in with Michael Lebowitz here. He's standing by in the green room right now. But we'll talk about the Fed yesterday. And of course, we've been talking about this Santa Claus rally, and the question is whether or not now did the Fed just steal Christmas? And we'll see what happens here over the next few days. But there were a few things leading into yesterday's sell-off. So let's kind of get into that right now. Here's what you need to know before the bell this morning. Yesterday, the Federal Reserve, of course, announced that they did cut rates as expected. Language was a little bit more hawkish than expected. And the dot plot, which is the famous plot of the Fed, of the different Fed voting members' expectations of where rates will be, they published that out. That suggests that they will only cut rates 2 times next year. The market was expecting 4. So that kind of took some of the juice out of the punch bowl, so to speak, yesterday, and really kind of spooked the markets a bit. First things first is that the Fed is never right about anything. And these predictions are the worst on just about everything they ever do. So just because they're predicting right now that they'll only cut rates twice next year, any sign of economic weakness, they're going to cut 6 times next year. So it doesn't really mean a lot, but the markets are just so hinged now to everything the Fed says that, we just have these big kind of drastic moves in the overall market. But yesterday, that's what happened. Again, now, before we look at this, in order to have a correction, we've talked about this numerous times, you've got to have all the right ingredients, right? It's like baking a cake. So I want to have a correction. What do you need for that? Well, I need extremely suppressed volatility, right? I need everybody to be very complacent in the markets and not be expecting a correction, because when people don't expect something, that really helps amplify the outcome. I need bad breadth in the markets, which we've definitely had lately. We've had some of those negative breadth that we've seen in quite some time. And momentum needs to be declining even though the market's not. And that's exactly kind of what was going on over the last couple of weeks. We had declining breadth. We had declining momentum across the board. And then you had the market that was not oversold yet. And so yesterday, when the market made this, or when the Fed made this announcement, all those catalysts that catalyst ignited all those ingredients in the mix and caused this panic sell-off yesterday, starting right at 2 o'clock. Markets were down 3% at the end of the day. Importantly, on a technical basis, we did take out the 50-day moving average. So in order for the markets to get a rally here into the end of the year, we need to get back above that 50-day moving average pretty quick. Tomorrow would be great to be back above. If we get a little bit of a rally today, tomorrow, get back above that 50-day moving average. That'll keep this kind of bullish trend in track, and will set up for that rally into the year end. And particularly, the markets are very, very oversold here. Previously, when we've been this oversold on a short-term basis, we typically get rallies. So again, you kind of look back in history, when you have these big oversold conditions, typically leads to a rally in the market. So we'll see if the markets can get together. If Santa Claus is going to come, he better show up pretty quick. That last 5 days of the year is going to be critical. So again, the sell-off is certainly kind of the setup now for that Santa rally. You've got a nice oversold condition. But again, this kind of negative breadth in the markets and things that we've seen here the last few days certainly are concerning. It was interesting very early this year, we had done some analysis, which, by the way, I have coming out tomorrow for 2025, using valuations to create outlooks for 2024. And our target for 2024 was 6,000. With yesterday's sell-off, if we get a rally in the year, and we're going to be right around 6,000, so we'll be pretty close to being on target based on expected valuations that we did last year. So tomorrow's article on the website is using current valuations and earnings estimates to predict outcomes for next year. And the real key to that is going to be earnings growth. If earnings don't meet expectations, next year is going to be a fairly flat year. And that's just because valuations are so elevated right now. It's going to be a very interesting outcome for next year. Definitely expect a pickup in volatility, more so than anything else, as we get into 2025. But overall, just kind of looking at this is not surprising that this happened yesterday. Markets were very complacent, and we talked about the risk of a bit of a volatility shift, and we certainly saw that yesterday, because we saw a very big pickup in volatility that happened very shortly right after the Fed announcement. Now, this morning, it's going to reverse almost all of it. So again, we had this very sharp spike in volatility yesterday. This morning, volatility is already back to 20. So again, we're kind of setting up for that year-end rally, but pay attention to volatility. If volatility doesn't come back down, it's going to be hard to press that rally into year-end. But that's what you need to know before the bell this morning. We'll come back, pick up with Michael Lebowitz, talk all about what the Fed said and didn't say yesterday and what it all means. What does it mean for bond yields? We'll talk about all that coming up on the Real Investment Show this morning.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
What will a Trump presidency mean for your money? What is the market outlook under the new administration's policies? Register now for the RIA Economic Summit 2025 Market Outlook under a Trump presidency, featuring Adam Taggart of Thoughtful Money, RIA Portfolio Manager Michael Lebowitz, and Chief Investment Strategist Lance Roberts with the RIA crew. Saturday, January 18th. Register today for the RIA Economic Summit 2025 Market Outlook under a Trump presidency at realinvestmentadvice.com. Realinvestmentadvice.com. Register today.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
You're listening to The Real Investment Show.
And you can find them right.
And welcome back to the show this morning. All right, Michael Lebowitz joining me from the green room today. He's all dressed up, even shaved today for you guys. So I just want you to know he is all prepped and ready for this morning's conversation. Mike, how are you doing this morning?
Can't complain.
There he is. Wait a second. We didn't have any audio there for you for a second, which actually sounded the best you've been in a while.
Thank you.
So, all right, let's get into it. Everybody wants to know, did the Fed steal Christmas? This is, kind of yesterday, the expectation is the Fed was going to cut rates and then probably announce a reduction in rates. Pretty much, I didn't really see anything that wasn't already expected. The market certainly didn't like it. Was there anything in the statement that was surprising to you, or do you think actually surprised the market?
No, I mean, in fact, the statement barely changed. They added 2 or 3 words to it that basically alluded to that future rate cuts will be dependent on data, which they've been telling us for the last 2 or 3 months. The only, I don't know if it's surprising, but the big change was in their quarterly economic projection. So once a quarter, they give you their projection for where GDP, unemployment, and inflation will be for the next year and 2 or 3 years, and then the long run. And they increased their inflation expectation for next year. They brought it, both the PCE and the core PCE, to 2.5. Both of those are higher than the 2.1 or 2.2 they were last year or last quarter, 3 months ago, but they're in line with where PCE inflation is today. So, they're kind of telling you that instead of inflation trickling down over the year, they think it'll stay steady. But bear in mind, they have not had a good gauge on inflation ever since 2020. And Powell went into a lot of detail numerous times during his press conference talking about inflation, because that's the thing that kind of caught the reporter's attention. And what I found very interesting was he kind of said what we've been saying, Lance. He said, first of all, goods inflation is now at or below target. He said service inflation, not counting shelter and imputed items are kind of at target. So he brought up the housing market, shelter, and the fact that it's just grossly lagging what we're seeing in the real market, but he said he is starting to see it finally come down. And then he brought up some random things, like he brought up insurance. And insurance is one of those items that the inflation in insurance lags. You know, as people get into car accidents, for instance, the price of new cars hits the insurance company, so they raise rates. So when used car prices went up a few years ago, that's hitting the insurance companies recently. Financial services, he said, are higher, but they're higher, and this is what he said, because assets have grown, because the stock market is up a lot.
Right.
So assets have grown. Investment managers charge more because they most charge as a percentage. So it's not necessarily inflation. Inflation is if the rate they charge you is increasing. They're charging you on a higher amount of money because you have more money.
Right. And let's explain that real quick, just so everybody can understand and because it's a good point, is that asset managers aren't changing their fees, right? They're not going from a 1% management fee to a 1.5% management fee. It's that the 1% fee on $1 million is, that rate, and then 1% on $2 million, that rate goes up, right? The amount of money you're paying is going up. So it's not inflation in terms of price inflation, because the price isn't changing. It's that the asset values are changing, that the percentage fee is charged on. But it shows up as inflation in financial services.
So when you kind of dissect kind of what he told us and the projections for inflation staying stable, it kind of leads me to believe that they're uncertain about next year, and in particular, probably tariffs. How will tariffs affect inflation? And he was asked that, of course, numerous times as well. And he said, look, we don't know what the policy is. There's going to be a lot of negotiations, but ultimately we don't know what the policy is on what goods, and therefore we don't know what the effect is. So it sounds like the Fed's being a little conservative. They're not getting the market's hopes up for a series of rate cuts like the market had been expecting a couple months ago. But going into this meeting, the market was only expecting 2 rate cuts. And in the Fed projections, they're expecting 2 rate cuts. So largely in line. But I think it's the inflation thing that kind of shook the market. What I don't really understand is the bond market reaction. Specifically, the long end of the bond curve sold off, yields went higher. If the Fed is being more aggressive or more hawkish and more concerned about fighting inflation, that should be a good thing, especially since inflation is more or less under control now. It wasn't under control in 2001, 2002. They were purposely raising rates aggressively to get it under control. It's under control, and their forecast has inflation basically staying at the same level and then going back down to 2% over the next year. So a more hawkish Fed is more of a headwind to economic growth, which is more of a headwind to inflation. It should damper inflation. And I think, Lance, at the end of the day, what this really does is it makes them a little more hawkish now, but it sets the market up for a dovish pivot, probably, not that far into the future. He also, on the unemployment, there was one interesting point he made there. He said that the hires rate is decently below where it was before the pandemic, but no one's really getting fired. But what he said is, at the current rate, at the current hires rate, the unemployment rate will rise. And I thought that was an interesting comment, because 6 months ago, the unemployment rate is what was concerning to them. And that it was kind of slowly ticking up from 3.7, 3.5, all the way up to the low 4s. And now he's kind of telling you they expect it to slowly grind higher if current conditions stay the same.
Right.
So, I think we're setting up for a dovish pivot at some point, maybe first quarter, second quarter. But again, it's going to be very data dependent.
Well, and again, this is, kind of, and 2 things to take away from this, everybody's immediate kind of knee-jerk reaction to this yesterday. And there was a lot of selling yesterday that really, I think, had nothing to do with the Fed. Again, we've talked about before is that there was a lot of tax loss selling that needs to get done. And I think we just saw a lot of that yesterday because, for instance, if inflation is supposedly raging higher, and this is why the Fed's becoming more aggressive, why was there a 2.3% decline in gold, right? I mean, that gold should have done great yesterday on expectations that inflation is going to be higher if the Fed is having to cut back on its rate cuts. And then you had the same kind of negative reaction in bond yields, which actually, as you stated, yesterday's announcement was actually bond friendly, not bond negative, but you had a big jump in yield. So again, you got to kind of take some of these knee-jerk reactions that occur because, again, today's trading is so computerized, it's so automated that, immediately when some piece of news comes across the headlines, the algos just immediately buy or sell everything. And it's really kind of more indiscriminate than anything else. So, we'll have to wait a couple of days to see how this all kind of works itself out. But, from a bond perspective, they're very oversold here. You're back to your rising trend line. So, at this point, you should be in a position to say, this is where I want to start buying bonds, not selling bonds. But again, you just have all this knee-jerk reaction going on in the markets.
Right. And I got a few emails last night and same kind of thing. There was a little bit of panic in their voices.
Mm-hmm.
And my advice is just give it a few days, let it shake out. Let's see what the market reaction is. Bear in mind that Friday is a huge option expiration day.
Right.
So there's a lot of volatility because of that. You have a little less liquidity because we're nearing year end and banks try to reduce their balance sheets. So there's less liquidity. And this is all coming at a time when there's a lot of rebalancing by institutional investors.
Mm-hmm.
There's a lot of tax gain and loss activity. So it's probably the worst time that he could have done something like this.
Mm-hmm.
But nonetheless, he basically threw a somewhat of a shocker into a market that was kind of off kilter.
Well, yeah, and I talked about, it's a great point because, again, I was talking about that at the opening. You had terrible breadth over the last, 10, 15 days. Right. Breadth has been terrible. The market was overbought on several levels. It's not anymore. But, you had a MACD sell signal in place telling us that momentum was already declining in the markets. So, as I said at the open, you kind of had this tinderbox sitting there and it just needed the match. And Jerome Powell yesterday was like, here, let me throw the match in. And, so you got this immediate kind of knee-jerk reaction, and again, it was across all assets. It was Bitcoin. It was gold. It was, it didn't really matter what you owned yesterday. It went down. So
right.
It's just one of those days.
Even Fartcoin was down.
Imagine that. But it was the biggest decline we've had since the yen carry trade blow up, and I would suggest that the yen carry trade blow up was probably a lot more significant than yesterday's Fed announcement. But that just kind of shows you how reactionary the market is right now, and I certainly wouldn't take any clues from yesterday's action and try to extrapolate those into some macroeconomic theme over the next 12 months, because as we'll talk about when we come back from the break, the Fed is wrong all the time with these projections. And to Mike's point, we may very well see them making a pivot in the next quarter going in the other direction. We'll talk about all that and more when we come back from the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
What will a Trump presidency mean for your money? What is the market outlook under the new administration's policies? Register now for the RIA Economic Summit 2025 Market Outlook under a Trump presidency, featuring Adam Taggart of Thoughtful Money, RIA Portfolio Manager Michael Lebowitz, and Chief Investment Strategist Lance Roberts with the RIA crew. Saturday, January 18th. Register today for the RIA Economic Summit 2025 Market Outlook under a Trump presidency at realinvestmentadvice.com. Realinvestmentadvice.com. Register today. Register today.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Show your love this Christmas by giving a used gift to somebody you love.
Nothing says Merry Christmas like a 2005 big screen TV.
Merry Christmas to you too, you little freak. On a roll this morning. Anyway, I may be divorced by the time I get home. It's better than stimulus.
Listen to the Real Investment Show podcast from your favorite service. Same show, your schedule at realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Lebowitz. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So, just for the break, talk a little bit about the Fed policy announcement yesterday. And, again, as we go back, and particularly as it comes into interest rates and bond prices and those type of things, these short-term movements in bond prices are psychological. It's just sentiment, right? So something happens and, it triggers a hedge fund to start automatically kind of selling bonds. And so you get an uptick in yields, and everybody tries to extrapolate that out into, oh my gosh, what does this mean? Does this mean that inflation's coming back now all of a sudden? And as we've talked about with you before, and we've shown you the data multiple times, there is the short-term wiggles and yields and bond prices has nothing to do with what drives yields and bond prices. Yields and bond prices are very fundamentally based because it's based on economic growth, wages, and inflation. And in order to have higher yields, and again, there's been a lot of talk out lately, yields are going back to, 10%, 7%, whatever the number is. That's fine, but you've got to have the economic growth to support it. So if you believe that yields on the 10-year Treasury are going to 5, 6, 7%, and they're going to stay there, make the case for how you're going to economic growth to go to 5, 6, or 7%, because that's what you've got to have. You've got to have a relative, and if you go back through history and look at economic growth versus interest rates, there's a very high correlation to the ebbs and flows over time. And it's just simply a function of how yields work, because they're based off the very things that are derived from economic activity. So for those expecting much stronger, higher yields next year, you've got to start expecting stronger economic growth. And the question then becomes, where does that come from? So Michael did an excellent article on Wednesday. It's on the website right now, talking about the global economy.
Actually, Lance, can we backtrack 1 second?
Sure.
I think that's an important topic before we kind of talk about my article.
Okay.
Because one of the other things that I was going to say Greenspan, one of the other things that Powell said was that policy is very restrictive. And I agree with him. And, probably going to get a few chuckles on YouTube. What do you mean policy is restrictive? Bitcoin's going to the moon and stocks are flying. What he's really saying is that the real rate, so the Fed funds rate is almost 2% above the inflation rate. That you have to go back over 20 plus years right before the financial crisis to have a real rate that was that high. In other words, let's pretend you're a business owner and you have a project you want to invest in, and it'll cost 10% to borrow the money, but the project will only return 5%. Mm-hmm. That investment isn't going to work. Your cost of borrowing is more than your return on the investment. As an economy, you have to think about it the same way. And if the rate of Fed funds is higher than the economic growth rate of the economy, it becomes very hard for the economy to keep growing. Certain parts of the economy can't grow because the money is too expensive to borrow. And that's the difference between bonds and stocks, to your point, Lance. Mm-hmm. If NVIDIA trades at a price to earnings of 40 or 400, the effect on the economy is very, very minimal. Maybe it generates a little sentiment, positive sentiment, and a little extra cash for the few people, relatively very few people that own it. But when interest rates go up like they did yesterday, that 10 basis point increase in interest rates on mortgage rates, on auto rates, affects everything. It affects the whole economy. So keep in mind, a lot of people out there are saying, oh, Bitcoin going to the moon and the stock market goes up every day. It's so speculative. He should raise rates to 6 or 7%. We'd be in a depression if he were to do something like that, because the economy can't operate with yields that high. And yes, it would get inflation down, but it would get it down to negative. So he's trying to balance. He's trying to walk a tightrope here. And you know what? I hate to say this, but he's been successful.
Yeah.
I mean, I'm glad he's successful, but I hate to
admit it.
I hate to say that Powell is doing a really good job, because we've seen a lot of blunders out of Powell and out of his predecessors. But he's brought the economy to a nice, even pace, right? The economy is growing. It's growing certainly much better than the rest of the world. Unemployment remains relatively low. Inflation is only 2.5%, right? It's not 6, 7, 8%. It's 0.5% above their target. And it's not rising rapidly, and there are no indications it's rising rapidly or even rising at this point, other than just jittering up and down. So, try to put this into perspective, especially kind of when you think about, well, bond yields are going to keep going up, and what that, there's a big differentiator between that and stock prices and Bitcoin prices and other asset prices.
Yeah, and again, stock prices are based on speculative views, and bonds are based on fundamental views. Because again, as we've talked about before, if I'm a lender, I only get a set rate. So whatever rate I set for that term of the loan, I'm stuck with it. So that rate better be high enough to compensate me for the expected rate of inflation, the expected rate of economic growth, credit risk, all those type of things. And so, rates are, and again, if you take a look at where inflation is and where rates are, they're about where they should be at this moment. And everybody's like, oh my gosh, rates are so high. But, based on economic growth at 3% real right now for the fourth quarter, according to the Atlanta Fed, we'll see how accurate they are. But, if I'm getting a point and a half over a 3% economic growth rate, that's an okay premium, right? I would probably do that deal. But I'm not going to charge 2% on a 10-year treasury if the economy is growing at 3.5, right? That doesn't make any sense, right? So, and I think people forget this, is that, ultimately this is going to come down to where the economy winds up. And this is the mistake that I think Powell may be walking himself into, is if you do look at some of his commentary and kind of the outlook of the Fed members, they're kind of expecting the stronger rate of economic growth in kind of the near term, and they're still expecting a 2% inflation rate and a 2% Fed funds rate, on the longer term basis, right? 2026, 2027, they're going to be at 2% expected. But I think that slowdown may occur a whole lot faster than what they're currently thinking. And that may be the kind of the quote unquote trap they get themselves into. And to your point, they're going to kind of be forced into a dovish pivot probably sooner than later. And again, this is kind of where this goes to your article. And I'll let you take it over from here. But if we look at the rest of the world and what's going on, whether it's the UK, the Eurozone, Japan, Germany, wherever, those economies certainly don't look like our economy.
Right. The world is in a recession. So the question is, why do we care? And the answer is because globalization of trade has increased for since World War II. It has steadily increased, meaning that there's more and more globalization, despite tariffs, despite everything that's happened. It's the rate of the percentage of GDP. Trade as a percentage of GDP has steadily increased. So what I do in this article is we take a trip around the world and we look at some of these other major developed economies and, look at them. But we start off with, let's just look at correlations. What's the correlation between the U.S. real GDP and that of other nations and other regions? And when we do that, the correlations are extremely high. They're 0.80, 0.90s against the world, against the OECD nations, against the Eurozone. They're well above 0.80. And when you just graph the real GDPs together, they're lines that all look the same. Mm-hmm. Every country, just about every country. And correlations over the last 10 years have risen versus the prior 10 years. So, unless there's a whole change in the world order and, there's massive fiscal stimulus coming down the pike, it's hard to see how the U.S. economy continues to diverge from the UK, which is borderline recession. They've had 2 months of negative economic growth, and ever since June, growth has been flat. Germany, which has basically been in contraction now for almost 2 years. Japan, which has meager growth. They're growing slightly, but it's meager. The big one is China, who has 2 to 3 times the GDP of those nations that I just said, who is seriously slumping, and their bond yields are collapsing, along with demographic problems. They massively overbuilt the country, so they're in a Japan-like funk that could last multiple years, if not decades, because they grossly overbuilt that country so much. Canada is another example that's borderline in a recession. So the difference is that we stimulated the economy much more during COVID and over the last couple of years when COVID was waning. And that is still paying benefits, like the CHIPS Act, for instance, the Inflation Act. There were a number of the student loan not paying the bills, deferrals. So there were a lot of benefits that are still kind of reigning on the economy. But as we've said numerous times, those are fading quickly. And if the rest of the world is in a recession, that's a huge damper on U.S. growth.
Yeah. Hold on to that real quick. We got to jump to a break. We'll be right back. We're going to finish up this conversation because, this part about, a global weakness versus this U.S. strength is an anomaly that historically doesn't last long. And the question is can the rest of the world catch up with us, or is it the other way around? And historically, what's been the case? Be right back after the break with Michael Lebowitz.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
What will a Trump presidency mean for your money? What is the market outlook under the new administration's policies? Register now for the RIA Economic Summit 2025 Market Outlook under a Trump presidency, featuring Adam Taggart of Thoughtful Money, RIA Portfolio Manager Michael Lebowitz, and Chief Investment Strategist Lance Roberts with the RIA crew. Saturday, January 18th. Register today for the RIA Economic Summit 2025 Market Outlook under a Trump presidency at realinvestmentadvice.com. Realinvestmentadvice.com. Register today.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Lebowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show. Get ready to wrap things up. But so just kind of leaving off last break, one of the potential kind of pitfalls that both the market as well as the Federal Reserve is walking into next year is assuming that the current rate of economic growth in the U.S. is normal. And that this is organic growth. This is just, how things are and the way they should be. But that's not actually the case at all. And there's some indicators that tell you this, by the way. Take a look at leading economic indicators. This is an index that has a very long historical track record of kind of predicting where markets and economies are going to be over the next 12 to 18 months. That's been the longest stretch of negative readings ever on record. All right, the Chicago Fed National Activity Index, which is a very broad measure of 85 indicators of hard and soft data around the country, has been very recessionary for quite some time. It still remains so, very negative readings. And we can just go through a lot of these different indicators that really tell you that real organic economic activity is certainly not something that supports GDP readings of 3% going into the fourth quarter. So a lot of this is still the stimulus and things that we push into the economy post-COVID, the Inflation Reduction Act, the CHIPS Act, all these things we've talked about before. There was just so much federal spending that's still kind of working its way through the system, but that's keeping economic growth elevated more than it would be otherwise. If we didn't have that money in the system, economic growth would arguably be a lot weaker and probably be much more in line with what we're seeing globally. And to Mike's point in his article, which is on the website, go to realinvestmentadvice.com, it's Wednesday's article, is that if you take a look at the rest of the world who didn't do these type of spending bills, their economies are reflecting what probably our economy should be reflecting in a more normal environment. Is that a fair statement, Mike?
We're just, it's still, we're getting the effects of all that stimulus. It's the longest hangover ever, but it's still there. The other thing to note is, some people will say, oh, but the government is still spending like drunken sailors, and we can debate that all day. But even if they are, if that rate, so let's just say the government today says we're going to borrow $10 trillion. We're going to have a $10 trillion deficit, and we're just going to buy stuff to boost the economy. So What would happen? Well, over the next year, the economy would grow by 10 trillion. So it would grow by about 25% or so.
Yep.
All right. And then they say, wow, that was great. We had 25% growth. Everything's great in this country. Well, you get to the end of the year and they say, we want 25% growth again. Well, if you only do another 10 trillion, if you do 10 trillion in spending again, you're just keeping afloat. So now you have to do 20 trillion. So the point is that economics work, the way economists look at data is with growth rates for the most part. And if the rate of deficit is staying the same, high or low or whatever it is, its influence on that growth rate is minimal, if anything. So, we've had a shock with these higher deficits, but they've leveled off. And that's going to start not affecting GDP. And if Elon Musk has his way and we're starting to see him kind of get a little bold with Congress, and if they're really going to start cutting spending, that's going to be a negative for economic growth next year. So, it's yes, deficit spending is high, but it's not as additive as it was a year ago. And it may be even negative as we go forward.
Yep, exactly. And this is, and again, that correlation that between the U.S. and the rest of the world is not surprising because, again, we're so global. And if the rest of the economy is slowing down, we're going to start importing that disinflation from those countries back into the U.S. So, that's just a function of time until it shows up. And that's the one thing that potentially catches, and to your point earlier, that's what potentially catches the Fed off guard. And all of a sudden they have to backtrack once again, which is something they do on a regular basis, is to backtrack and go, oh, okay, we've got to go back to cutting rates more because we're starting to see, economic slowdown, economic weakness, employment, unemployment rising, whatever it is. And they have to go back to, cutting rates and potentially at some point, reducing QT or restarting QE. That's just a function of time until we get there. The question is just, that's not going to be next month. It's not going to be next quarter, but probably sometime next year, we're going to be starting to see the impacts of that weaker global economics coming back into the U.S.
And also the stronger dollar. The dollar was up, almost 1% yesterday. So what that means is that assuming every currency was down 1% versus the dollar, which is true, some are more, some are less, but on average, that means our exports are now 1% cheaper than they were yesterday or a day ago. So the higher the dollar goes, the more those imports into the U.S. become cheaper for us, which is disinflationary or deflationary. So that's another key factor to keep in mind is the stronger dollar that comes with the Fed kind of staying on hold while every other country is starting to get a little more aggressive with rate cuts, right, and their economies are suffering. So the other question is how much longer can the dollar rally versus all these other currencies, and
which exacerbates the economic weakness in those other countries.
Right. And it also is something that the central banks talk to each other all the time and they try to manage currency rates, and they go into markets just like they do with QE, and they're always tampering with currency markets. So that may be something we should expect kind of in the coming few months is some effort by the Fed and other central banks to push the dollar down, which would stifle growth here to some degree.
Yeah. Well, and again, it's here's the bottom line. So, if you're long bonds in your portfolio, understand that on a very short-term basis, they trade very technically. Hedge funds, et cetera, they're buying and selling bonds all the time, for either hedging purposes or for trading purposes, whatever it is. We had a very strong 4% rally in bonds a few weeks ago. They got very overbought short term, so this pullback has now gotten bonds back to oversold. And on a very short term basis, if you're just trading bonds, just use technicals. None of this other stuff that Mike and I are talking about has anything to do with bonds short term, right? Because these are all big fundamental drivers of long-term rates and where rates are going to be over the next 5 and 10 years. These are very long-term outlooks in terms of the macroeconomic drivers. In the short term, it's all technicals. And so you've got a lot of automated trading that's going on, with bonds on a short-term basis that's pushing rates to overbought, then they go to oversold, go back to overbought, back to oversold. So, if you use technical analysis at all, you can trade bonds very well on a short-term basis. But on a long-term outlook, if you're buying bonds for a long-term outlook and you're saying, look, I'm going to buy a 10-year bond and I'm going to hold it for 10 years and I'm going to collect 4%, what's your outlook on rates over the next 10 years? Well, if your outlook on rates over the next 10 years is higher rates, you've got to figure out mathematically how to get stronger economic growth, stronger rates of inflation, and higher wages in an economy where the rest of the world is going in reverse. And that's the difficult argument to make, and that's where a lot of the long-term views about, we're going back to 1970s inflation falls apart, because we don't have the backdrop to support higher rates. And just the very fundamental fact of the amount of debt that we have, not just government debt, but corporate debt, personal debt, et cetera, which a lot of that was financed at very low rates, they can't sustain higher rates. And if once rates get to a level that kind of break the bank, so to speak, you're going to have a very, very sharp negative recession, which will bring rates down again because of the impact of slower economic growth. Mike, I'll let you wrap it up.
Yeah. Well, I just pulled up while you were talking. I just pulled up the Fed's long-run projections. Mm-hmm. So this is 2028 and beyond. Their real GDP projection is 1.8%. That's where it was in September. And prior to COVID, I believe it was 1.9 or 2%. Mm-hmm. So, they think PCE inflation will be 2%. This is, again, the long run. The Fed is telling you nothing has changed. In fact, what they've told you through these messages is that the future economy has actually weakened slightly from what it was in 2019 to what they expect it will be today, despite the stronger growth that we've had. And that's kind of the key for bonds, is that inflation will get back down to 2%. We'll probably go well below 2% at some point, especially in a recession. Real GDP is kind of fighting gravity at this point, global gravity. And it's just some of that stimulus is just still keeping activity higher. The jobs market is weakening. I mean, Powell admitted that to some degree, but it's not showing up because people aren't getting fired. They're just not getting hired. So, bond yields they're too high right now. I mean, it's crazy to say, but they're a little too high. And I think when everything kind of catches up with itself, the global economy as well as the U.S. economy and the lack of stimulus, that's when the Fed is going to have to kind of surprise the market and start going the other way.
And this will certainly be a topic that we discuss in a lot more detail with charts, graphs, all the relevant issues at the upcoming Economic Summit in January the 18th, Saturday. Michael will be there live in person. You can visit with him afterwards, of course. We'll hang out for a while and chat with you. But tickets are limited. They are on sale now at an early bird discount of $99. They will go up to $149 on January the 1st. So make sure you go to the website now, get registered. We'd love to see you there, love to meet you. We've also got a block of about 10 rooms set aside. So if you want to come to town, we've got a special rate on rooms at the hotel. If you want to fly in for the conference, we'd love to see you. All right, that wraps up the show for today. Let me wish you a very Merry Christmas for you and your family. Have a blessed Merry Christmas. Enjoy yourselves, enjoy your family, enjoy your time. Don't forget, we'll have plenty of podcasts for you on our website, realinvestmentadvice.com, and we'll see you next year.